Am I audible? Can we begin, everyone? Okay, let us begin. Very good morning, all the CA final AFM and CMA final SFM students. So today in this session, just for half an hour, we will complete this particular segment called as risk management extra questions. Another 3 to 4 questions we are going to solve. Once we complete all those, we are going into the next segment called as security analysis. Okay. So another segment for 6 to 8 marks will come in examination. So that particular chapter is called as security analysis. Students are consistently leaving that chapter. So I am putting it in the first place itself. So let's cover, and then we'll be going into capital budgeting. Okay. Before we go into that, and again, first 3 days of the classes. Okay. First day anyway, it's an introductory time. Second day and third day, I went a little slow for maintaining the pace for all the students. Okay. So don't think that all the sessions will be held that way. Since risk management chapter completely students are leaving, we went into in-depth like a regular session. I explained the concepts, basics, background, analysis, everything, and we completed. But for the next chapters to come, please do not expect the same for a EO batch. Clear? So with an intention that you know at least some basics, I will explain the background, but not but that much of time. So fastly, I will try to complete all the concepts. Clear, everyone? Okay, done. So let us start with our concept now. So I have some practical questions also with me with regard to risk management chapter. Same questions were there also in our question bank. Okay, this question already we have done yesterday, if you remember. First question in question bank. Okay, so now we are going to solve question number 2. Okay, wealth 2 crore, standard deviation 2% per day, number of days in a year 252 trading days. If they gave you clearly number of trading days, please do not make any observation that how come it is possible trading day should be only 250. They give, take it. If they do not give, then 250 is our assumption. So number of days 252 trading days, confidence level 99%. At that level, Z score 2.33. Daily VAR, 10-day VAR. Two things he is asking us to calculate. Okay. So first point number 1. Wealth is given. Standard deviation given. Mean not given. Mean is not given. So in the previous questions, if you observe, in one of the question, mean was given clearly. Correct or not? So here wealth is given. Standard deviation given. Number of days, confidence level, Z score. He is asking two questions. Number 1, daily VAR. Number 2, 10-day VAR. How to compute? First thing, wealth was given. So what is the first situation or first step that we need to proceed? Number 1, whenever risk management question, these kind of VAR computations come, the simple logic behind this is VAR equal to wealth into, okay, Z into standard deviation. Technically, it is a minus wealth because VAR is a negative number. Okay. So what is the wealth? 2 crore. 2 crore into Z value 2.33 into standard deviation 2%. Okay. So that's what we have done. So 2 crore rupee into 2%, 4 lakh, and the daily VAR will be 2 crore into 2.33 into 2%. So 2 crore into 2.33 into 2%. So totally it came to how much? 9.32 lakhs. Okay, you can take your calculator and you can check. 2 crore into 2.33 into 2%. 0.0932. That is given in crores, na? Multiply with the crore. 9,32,000 is our answer. 9.32 lakhs. Next, how to compute the 10-day VAR? Whenever normal question is given, 10-day VAR means daily VAR into root of T. Daily VAR 9,32,000 into root of 10. That's it. 10th root into 9.32. 29.47 lakhs is our final answer. Everyone in the class, answer please. Did you understand or not? Okay, done. Next question. I told now I will go little faster. Let us start. Investor is Neil. Prashant Neil, normal Neil. He is busy in Dragon. Sorry, okay. I will show you that question. This is the question. This question A, May 2018, they asked. I converted that into these particular facts. Okay, so let's read. Neil holds rupees 1 crore shares of XY Limited, whose market price standard deviation is 2% per day. Assuming 252 trading days in a year, determine the maximum loss level over a period of 1 trading day, 10 trading days with a 99% level of confidence. Assuming the share prices are normally for the level of 99%, Z score is 2.33. Now, 2 minutes time I will give, solve the question. Everyone try solving the question. Please don't sit idle. Everyone try solving the answer. Completed? Completed, everyone? I said clearly in the yesterday's class itself, today you are going to solve the questions. Fast, fast, be very fast. Okay, see here. First one, wealth 1 crore, standard deviation 2%, confidence level 99, maximum, Z value will be 2.33. War for 1 day, war for 10 days. First, war for daily war, or war for 1 day. So minus W into Z into standard deviation. 1 crore, 2.33 to 4.66. Root 10, 14.74. Everyone got the answer? Okay, done. Next issue, next question. Now you people will do. Okay, you will try. Again, this is a November 2020 question, exam question only. Let us observe the question first. Very, 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 very important question. Okay, let's begin. On Tuesday morning, before opening of capital markets, an investor, while going through his bank statement, has observed that an amount of rupees 7 lakhs is lying in his bank account. The amount is available for use from Tuesday till Friday. The bank requires a minimum balance of rupees 1000 all the time. The investor decides to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. The standard deviation of market price of security is 1.5% per day. The required confidence level is 99%. Okay. Table was also given. 99%. 99%. So 99% what is the amount he is asking? This already we know that it is 2.33. Like that we can write by remembering. Second way is we want 99%. 99% is somewhere between, okay, 99% is somewhere between this and this. Okay, 99% fully. It is 99.98, 99.99 and 01 if you take. This is 2.3 plus 0.0302. So this is 2.32. 99.01 exactly 2.33. Like that also we can compute. Okay. So this table, even though he did not give, we remember this because we have done so many problems in the same way. Generally in exam, 99%, 95%, 90% comes in exam. Even if they give a new one, you know how to check using this table. Interpolation method we need to use and we have to do. I think everyone had that clarity. Yesterday already I made you to understand how to do that. Okay. So that question, you are required to determine maximum possible investment. Okay. Very good question. Read. Read the question first. Please read the question properly. Okay. Have you read the question, everyone? 2 minutes over. Okay. Now see what is unique in this question. Okay. What is unique in this question? I want participation. Please listen. See what is unique in this particular question. In this particular question, for the first time in exam, they asked a question on wealth, not war. War already they have given. Okay, war they have already given. They are asking you how much wealth to invest. First of all, this clarity you should have in your mind while doing this question. Because I told you the other day when we started with risk management, you will be mugging up procedures and formulas and you will go. Definitely they will ask reverse. Gone. That attempt is gone. Later you will learn. Why to do that? Learn from the beginning itself all the corners, not just past exam questions. So see, on Tuesday morning, investor while going through the bank statement observed that he has 7 lakhs. 7 lakhs are in bank account. Okay. Now, this amount is available for use from Tuesday till Friday. Bank requires a daily minimum balance or minimum balance of 1000. Why I am using daily minimum? All the time it is required, na? So daily you should maintain. So 7 lakh minus 1000. 7 lakh minus 1000. And a first thing, 6 lakh 99,000, 6 lakh, 7 lakh na. Understand the concept clearly. 1000 you remove. 6 lakh 99,000 is only available for investment. He cannot invest 7 lakh because in that 7 lakh, 1000 is a bank minimum balance. So that is the amount that you need to block. Investor decides to make maximum possible investment where the value at risk should not exceed the balance in his bank account. Balance in his bank account. The standard deviation 1.5, confidence level 99%. Like that, they tested the question. Okay, wow. So I have given the answer here completely. This is a study material answer. This is what answer? Study material answer. But I presented this in a better way possible. Okay, I'm not boasting, but still, I should tell. I have presented the same question in a better way possible. Let me show you first. Yeah. 1 second, 1 second. Let me see the question. This is the question. Yes, see here. Wealth 7 lakh. Wealth 7 lakh. Minimum bank balance 1000. Standard deviation daily 1.5%. Confidence level 99. Z score 2.33. First thing, in this particular circumstance, my total bank balance is 7 lakh. In this total bank balance of 7 lakh, 1000 is the minimum balance that I should block. So maximum tolerable risk is amount in my bank account 6 lakh 99,000. Calculation of amount for investment. Unlike other questions, in this question, they are asking us to calculate the wealth to be invested with a maximum tolerable VAR of 6 lakh 99,000. See here. Normally, what is our VAR formula? VAR equal to W into Z into sigma. Now, W is our missing figure. So, 6 lakh 99,000 is our maximum VAR equal to W into 2.33 into 1.5. Okay. And if you observe, he is asking us the question Tuesday till Friday. Tuesday, Wednesday, Thursday, Friday. And how many days? 4 days he's asking. So directly into root T means root 4. So 6,99,000 equal to, take calculator, 2.33 into 1.5%. It came to 0.0699. 0.0699 W equal to 6,99,000. W equal to 1 crore. Everyone understood the point clearly? Yeah? Everyone understood? Yeah. So this is one way. That's why I said, na, I have done in a better way possible than institute, I said. So this is one way. Institute does the same answer. Answer is same. Answer won't change. Methodology they changed. What they have done, they first computed total var and divided by root T, giving you daily var. Total var I want is 6,99,000. Daily var means what we will do, total var divided by root T. So root T comes to 3,49,000. 3,49,000 equal to W into, like this they have done. In that case also answer will be 1 crore. That's why in the institute answer you will find 3,49,500, all these things. What I have done is, why to do that nonsense? Anyway you are ready to do for 4 days, na? If you want to calculate wealth, okay, you wanted to calculate the wealth, that's it. So nothing more you need to do. So simple, whatever logic we already learned, apply the formula. So var equal to 4-day var equal to W into Z into standard deviation. Okay, into root T directly we will get for 4 days. So like that we have done. W equal to 1 crore. Everybody please tell me, are you all comfortable with this answer? Everyone. Okay, remember simple concepts here. You have to just concentrate on the chapter. Okay, next. This already we have done. This already we have done. This already we have done. These are all theory type. Theory definitely we will read separately. This also we have done. Now, this one. Suppose Mr. A holds rupees 2 crore shares of X Limited, whose market standard deviation is 2%. Assuming, hey, this you have done na? Just now. In my notes directly, facts that we have done this. Yes or no, everyone. Same question. 2 crore question. Done. That's why I say always do my hand material properly, because proper presentation I have written that. Okay, so if you do that, more than enough for the exams. Next one. So in this, let us stick out completed. Okay, XYZ ABC question we need to check now. Yeah, see here. Following is the 26th question. Following is the information about Mr. J's portfolio. Investment in ABC Limited, 200 lakh. Investment in XYZ Limited, 200 lakh. Daily standard deviation, 1%. Correlation, 0.3. Determine the 10 days, 99% VAR for Mr. J's portfolio. Z score 2.33. Now, I wanted to ask you one question. Here in this question, they have given standard deviation for both the shares is 1%. We wanted to calculate one share, ABC Limited, we have to calculate VAR, XYZ we have to calculate VAR, or we need to calculate VAR for the portfolio. What we need to compute? Portfolio standard deviation we have to compute. Tell me, what is the formula for the portfolio standard deviation? Root of, let us call ABC as A, XYZ as X. WA square, sigma A square. wx square sigma x square plus 2 wa wx sigma x or ax. Okay, root of 200 lakh mean total 400. 400 to 250%. So 0.5 square into 1 square plus 0.5 square into 1 square by 1 square standard deviation plus 2 WA 0.5 WX 0.5 sigma A 1 sigma X 1 into 0.3. Up to here, are you all agreeing with the answer or not? Everyone, are you all agreeing with this question formula or not? Yesterday also we have done similar one, but now I am presenting the answer also. That's it. Nothing clear, nothing great we are doing. Okay, well, so doing like this will give you an answer 0.8063. So once we get this, daily VAR computation will be 7.51. 10-day will be 7.51 into root 10, 23.75 lakhs. So fourth one also completed. Fifth one, bank balance question completed. Okay. Nothing great here. Remaining all questions are simple only. Okay. Now, let us take question number. Hey, see the screen now. 23rd question. Had we done already or not? You will tell. Question 23. Had we already done or not? Yes. 24. James estimated annual standard deviation of $750,000 on one of its projects based on a normal distribution of returns. The average annual return is $24 lakh. Estimate the VAR at 95% confidence level for a project life of 6 years. Read the question. Everyone, have you read the question? 1 minute time I have given for you to read. Have you read the question, everyone? Okay. See here. So James has estimated an annual standard deviation on one of its project based on this, all these things he has said. Okay. See here now. First, standard deviation is $750,000. Return per annum. You see here, average annual return 2 lakh for 24 lakh. Yesterday I told you, if they give mean will be considered mean formula. What is the mean formula? Mean minus z into standard deviation. I told you this. Sometimes they don't give you mean. What is mean? Yeah, mean is nothing but average return. So sometimes they will give average return. Average return is how much? 24 lakh. So that through we need to do now. Okay. Wealth is not given. So 24 lakh is a return per annum average. Confidence level 95%, 1.65 Z value. VAR for 1 year, VAR for 6 years. Okay. First, VAR computation formula. Mean minus Z into standard deviation. Okay. Mean minus Z into standard deviation. Mean 24 lakh minus Z into standard deviation 7 lakh 50. 11 lakh $62,500 is 1 year maximum loss that you can incur. In 6 years, 11 lakh 62,000 into 6 you should not do. For 6 you need to take root 2.45 it will come. 2.45 to 11 lakh 62 comes over to 28 lakh 47,532. Everybody please reply. Understood? Yesterday, did I tell you or not, Raya, very clearly? Whenever mean is given, take mean. Sometimes mean will not be given, but return word will come. At that time, return will be the mean. And I told you or not? There is no mistake from my side. I'm explaining every point. Done. So this is my presentation. Same thing Institute also will do. Okay. So same thing with the slight changes they will do. Next one. Okay, see here. This one also. Sorry. A trader has an allocation equal to 8%. Okay, a trader has an allocation equal to 8% of the firm's capital. Okay, the returns of this unit have a beta with respect to overall returns is 0.9. The firm's daily VAR is $120 million. What would be the VAR allocated to the trader's unit? This is the question. See, if I put question bank, you will copy the answers also. Read the question. Okay, what? See here. First, what they said, there is a trader. That trader is holding 8% of the firm's total capital. Firm's daily VAR is how much? 120 million. Portfolio beta to the firm's beta 0.9. VAR allocated to traders units he is asking. And I am not holding entire units. I am holding 8% of the capital. For my 8% he is asking. So VAR for the trader is total VAR into my percentage of holding into beta. So total VAR is how much? 120 million. How much is my holding? 8%. What is the beta of my holding? It's not same. It's 0.9. Okay. So 8.64 million will be my VAR. So my beta or my portfolio is not having 1 beta, is having 0.9 beta. Means if the overall firm changes by 1 time, I will change only by 0.9 times. Therefore, if the total VAR is 120 million, okay, for my holding, it's not 120 into 8%, 120 into 8% into my beta, 0.9, which comes to 8.64 million. More about beta we are going to discuss in the chapter portfolio management. Okay. Everybody please reply. Did you understand up to here? Illustration 9. I mean this question. In the book it is question number 25. If you say yes, we'll move on to the next one. That's it here. There are no great questions to solve. I think now everyone is fully confident about the chapter risk management. Everyone, additional questions, you take the question bank. Okay, additional questions, one or two questions, if they are, you practice and you can do. Main questions, whatever are required for the exams, we have done. Okay, done. So with this, we completed our chapter called as risk management. Okay, so one chapter was successfully completed here. Done. We are going into the next segment called as security analysis. Okay, security analysis. Sorry, before going into security analysis, any additional questions are there? Na? Just to give a practice and leave. Okay, no worry, nothing great. If you have my handwritten notes, you follow that. Or if you have any question bank, you follow that. Because remaining questions are also same. You can see investment 200 lakhs to 210 lakhs, 1 lakh investment, another question. All are same. Just another one is only a currency related thing. Okay, same correlation we need to calculate and we need to do. That's it. Okay. Question bank and handwritten notes are not same. Handwritten notes is complete concept oriented book with 400 problems. Question bank has 700 problems. Exams ke handwritten notes is more than enough. Question bank is for more practice, confidence builder. Security analysis, third chapter. First of all, everyone tell me, are you all comfortable with this? Okay, everyone keep the heading security analysis. Security analysis. So at the end of the today's class, okay, at the end of the today's class, I will discuss about any doubts in risk management, because I saw some questions in the chat box, some answer varying everything. Those all are rectified by ICA already. So I will tell you those also. Okay. If you say yes, we will start with the security analysis chapter. Shall we begin? See here. Name of the unit is, or name of the chapter is, security analysis. What is the name here? security analysis. Okay. So the next chapter we are going to start is security analysis. 5 marks to 8 marks you can expect in the exam from this segment. Security analysis, both at CA as well as at CMA, same questions are coming. Who is copying from whom, I don't know, but copying happening. Numbers also they are not changing. Blatant copy of questions. Okay, so security analysis is one chapter where there are 3 different models of questions we have to do. See here, concepts to be dealt. There are 3 concepts: exponential moving average, efficient market hypothesis, auto correlation, and run test concept. Okay, how many? 3. Exponential moving average, efficient market hypothesis, auto correlation, or run test concepts. How many are there? 3 learning objectives are there. On the 3 learning objectives, say questions will come. Sir, if those 3 are not tested, then theory will come. Theory separately we will discuss anyway. We are having 5 theory chapters. 5 theory chapters, risk management and security analysis is also there. So there we will discuss about that segment, theory. Clear everyone? Yeah. Notes, please open the notes. First write down, keep the heading. Okay, keep the heading. Exponential moving average, efficient market hypothesis, auto correlation, and run test concept. First write down that. They don't put the class like I will be shouting and you will be just sitting and listening. Practice along with me. We are going to complete this chapter today. This chapter will account for 5 to 8 marks in exam. Today timings, let me complete this chapter. Okay, we have to do 4 questions also in this. Okay, one question both of us will do, another question you will do, another question both of us will do, another question you will do. Practice will be over. Books, I think it was received in Chennai. People can go and collect. You can call them, go and collect. Yes, this topic is there also in CMA. Small bits and pieces they kept in the material, but it is there. They are asking also. Okay. Everyone, have you written? Okay. See. Name of the chapter, security analysis. First, let us understand how students are approaching this. 10 students appearing in exam, 5 will first leave this. Remaining 5, almost 5 or 4 will just remember formula, keep numbers, complete it. Question comes in a different way, attempt gone or choice. This is how they are behaving. But let us not do that after this class. Then what is the difference between before gaussification, after gaussification? Some impact should be there, a very good impact of understanding. So this will be the occasion for that. Okay. So mark my words. What is your thought process on this chapter before the class and after the class? Completely your mindset will change. Okay. So just what is required from you is you should understand that this concept requires stock market knowledge, which I will give you. Okay, deep knowledge is not required, but is required. Okay, but is required 100%. You should understand the behavior. Sorry. Anyway, let us begin. First thing, exponential moving average. And moving average, yeah? Exponential moving average. Okay. Next one, efficient market hypothesis. Next one, auto correlation or run test concept. Auto correlation or what? Run test concept. Okay. First one, exponential moving average. Sir, what is this exponential moving average? Concept I first explain. After that, I will show all illustrations. Then we will do one question. Then we will go to the next concept called as efficient market hypothesis. Okay. Listen carefully. For next half an hour, I want absolute attention on the concept such that you can do the questions on your own once you listen to the class. Okay, well? So let us go through that. Point number one. Point number one. Concept name is exponential moving average. Let us consider the following data. Okay. See, study material of the institute did not make an attempt to explain to the student what is exponential moving average. Direct hit one question, not one question, 3 questions answers, that's all. 3 questions, same ditto, numbers will change. What is the use without understanding what is the concept of moving average? So that's why I have taken a decent amount of examples first to understand what is a moving average. Daily moving average, weekly moving average, 5-day moving average, then exponential moving average can be understood. First of all, everyone tell me, understood what I said till now? This topic is there also at CMA final. I told already, still asking the same question. Okay, let's begin. From now, your work, make your ears bigger. Listen, my work, shout, explain you in, okay, explain you in the best way possible. Okay, let us begin. See, one time only I will tell. I will not repeat. Okay. Day. So first, what is the concept? Moving average. It's an average, but not a static average. It's a moving average. Say, the concept of moving average can be understood only if the student understands a static average. Correct? So let us first understand the concept. There is 16-day data. How many days here? 16-day data. X is what? Price movements. Share price is 100, 110, third day 120, fourth day 150. Like that, trading days are given, not days, trading days. And all 16 are 16 trading days. So these are all trading prices, closing prices of the particular shares during that particular day. Okay, well, so what is the subject matter of discussion? 16 days data is given. On the basis of that 16-day data, expect the price for the 17th day. I repeat again. I will give you the past history of 16 days. On the basis of 16 days, you tell how much you will expect for 17th. Okay. Normally, in portfolio chapter, first problem itself, I will tell this dialogue. Do you know what is it? Listen. there is a student, CA student. I conducted 5 in-house exams. I mean, revision exams they call. I conducted 6 revision exams for a student. And before he go to the final exam, 6 exams within us he will write first. See, exam 1, 2, 3, 4, 5, 6. AFM subject. In AFM, test 1 he got 50. Test 2 he got 80. Test 3 he got 70. Test 4 he got 50. Test 5 he got 60. Test 6 he got 70. This is how he got the marks. Example. Okay. Now I will ask you one question to you. 6 exams are conducted. Yes. 7th exam is direct ICA exam. How much you will expect from this student to get in the exam? You tell me. How much you will expect? I gave you past 6 exam results. I am asking you expect final exam marks from him for AFM subject. You tell the answer. I will wait for you. Okay. Now, answers people started giving 50 to 60, 60 to 70, 60 plus 55 plus. Yeah, like that they gave some said 63 like that. Like that you gave the marks, correct? Listen. Listen. Now I will tell like this. You ask this question to me. Mr. Kaushik, I will give you details of a student for the past 6 exams. Expect how much he will get in final exams, you said. I saw the data. Oh, 50, 80, 70, 50, 60, 70. Okay. I will go by conservatism. 50 I will expect. 50 I will expect. I said like that. Or, no, I am very, very optimistic. 80 he will get in final exam. That's how I said. Your 50 is wrong because it is the lowest extreme. Your 80 is wrong because it is highest extreme. Whenever I ask you to expect something, expectation should be always average. That's why portfolio chapter la expected return is called as an average return, also called as a mean return. Everybody understood the point clearly or not? Okay. So we will total all the marks and we will tell one average. Somewhere around 63, 64 it will come. So we will tell I will expect 63, 64, like that we will tell. Then he will ask, why you are expecting 64? Asal 64 is not there in any of the details given there. 64 is not there in any of the details you have given. But that is an average mark he is getting overall throughout the 6 exams. Same thing, stock market analysis also. Don't expect extremes, expect averages. Okay, so therefore what will happen here? The least score happened during 14th day, highest score happened during 11th day. So 11th day is the highest extreme 300, lowest extreme 40. How much you will expect the price on 17th day? Means you should not tell I will expect 40, lowest extreme, wrong. 300, highest extreme, wrong. You should not expect highest or lowest. You should expect average. First of all, everyone understood that? So now what I will ask you to do is total all the prices and tell me the average number. Start. Work out. Don't sit idle. Some people are just sitting and listening, which is not expectation. That is not expected of you. You solve along with me, you do along with me, you work along with me. Then you will complete chapter along with me. 200 students live means 200 answers I should get here, or else waste of time, you can leave the live. Don't round off, don't round off, write in decimals. Okay, very good. So 126.875. I am believing in you. Okay, 126.875. Okay, see here. 126.875. 126.875. Simple average. Average we have done. Okay, see here. See here, see here, see here. I have one point here. See, why moving averages are considered? Why what? Moving averages are considered. Okay, listen carefully. I will give you one classic example first, okay, to make you understand how this concept actually work in real life. I will first explain which concept. Moving average. Okay, moving average or average, anything. Listen, you have a very close friend. Okay, you have a very close friend with you. So now what is there? When you have your own friend with you, you will study or you will share the viewpoints, everything. You are very good close friends since a childhood. Let us say, for example. Okay, now a person came to you. Just before he came to you, there is a very big dispute between you and that person. Okay, now that person came to you and asked, please tell about the character of that person. Then what you will do? You will tell, first fellow, waste fellow, he is now not worth. So very bad character, like that you said. But try to understand, for around 10 years you are with him or with her, whatever the case may be, your judgment is based on the very immediate before experience of you with that particular person. And you are judging that character of the person and saying that he is good or she is good, he is bad or she is bad. Like that, we are forming an opinion on people. Clear or not? Whenever you form an opinion, what's wrong in forming opinion on the basis of variety of events rather than judging the character on the basis of the very before event? Very before event, like if you behave very good, if you are having some advantage from that person, you will tell a very nice person. Okay, character gold, diamond, platinum, you will tell. Something harsh thing happened between you and that other person, you will tell waste fellow, characterless, like that you will judge. And what is wrong here? Judging a person on the basis of one single event is always the wrong thing. Judge on the basis of multiple events. From that concept only, analysis of averages, moving averages came into picture. Did you all understand the logic clearly or not? Everyone. Everyone reply, I'm talking to you. Okay. So why these moving averages concept came into picture? Don't analyze a stock also just because of the previous day share. War is happening one day before the war, markets are running like anything. War started, markets fall. This market, oil and natural gas market, waste to invest. One day before, it is best to invest also. Suddenly, because of war that has happened, from this what you have to understand, when you are investing in the company also, do not take a decision on the basis of one day before that. Take the behavior of that stock for multiple days, and then you go and take a decision. Clear or not? So what we need to take a decision on the basis of averages. On the basis of averages, you take a decision. Averages, again, there are two types of averages. One among that is a moving average. Just a minute here, everyone. Just a minute. Okay. Double పెట్టేస్తావా? Thank you. Okay. So, where I am? So whenever you take a decision also on the share price, you need to take a decision not on the basis of just one event before that. You need to take a decision on the basis of some multiple number of days, such that the behavioral pattern of the share will be easily understood. So you also will not take a decision on the basis of character of the company for one single day. Understood? Now, read this concept. See this ones. Whatever the prices are there now here, I plotted them on a graph. Okay. Up to here, are you all thorough? Everyone live? Okay, now. Okay. Now, see also this. Have you all completed? Understood or not? Everyone? Understood the behavior of the chart or not? Everyone? Huh. So tell me, second chart you are seeing on the screen now, correct? Second chart, whatever you are seeing on the screen, okay? That is a combination of two things. Number one, this graph and straight line. Two things. What is this graph that this one? What is this one? This is the actual prices. What prices here? Actual prices. And this is average price. Average price. Okay. Now listen, I'm going to discuss something very important, unique in its observation. Please listen. Please listen. So what we understood, whenever I am asking the behavior of a share, don't judge the behavior of the share on the basis of 1 day before, 1 hour before, like that. Don't take and analyze the behavior of a stock. Stock behavior has to be understood over a period of time. Over what? Period of time. Okay. It's not just 1 day or a half day or 2 days, like that. Don't consider. Take a multiple data, take an average, and then analyze. See here. Now, what you said, what is the behavior of this company? Then you said, like this, you have shown the behavior. 1 day, very good. 1 day, very bad. 1 day, very good. 1 day, very bad. This is your analysis. But when you take average, no ups, no downs. Straight line is moving like this. How is the behavior? Plain behavior. How much difference is there in interpretation? Here you said, there will be a rise, fall, rise, fall, rise, fall. Like that you will tell. But when you take an average, entire analysis is changed. So what is right to analyze? It is to analyze actual. It is to analyze average. Which is right? Everybody. Okay. So everyone have shared your answers. Okay. See here. Now the question is, these are all actual prices. See here. I will write this way for your clarity. See here. These are all actual prices. If days, the prices. Okay. So let us say it starts with, okay, price called as a 20, 20, 40, 60, 80, like that. Price up to 300. So just let us try to randomly plot on the graph. Okay. Please everyone watch the plotted points. Data basis I'm doing it 100, 110, 120, 100, 110, 120, 150, 200. Okay. Suddenly 90, 50, 60, 150, 250, 300. Suddenly again 60, 50, like that they came. 40, like that they fall. And from this, what you have to understand, like this it went, like this it came. Correct? And from the behavior pattern, now a person asks you, what is this share? How it behave? They will tell it will raise, it will fall, it will raise, it will fall. It's a zigzag manner share. Yeah, you can't believe this share. You can't believe this share. One day it will rise, one day it will fall. Heavy rise will be there, heavy fall will be there. Why? God should know. So this is the behavior of the stock. If you consider day-to-day behavioral pattern of a share, and a right or wrong, wrong. Okay, but what we have done, we did not consider day-to-day pricing. We considered averages. Okay, static, simple average we have considered. When we considered simple average, what has happened? You see, like this a line went, okay, at a price range of 126.875. From this, what you understand? This share is a safe share. Every day price will be 126.875. This is also wrong and nonsense. Better than that, but worst. Reason is, and every day share price 126. 100, 110, 120, 150, 120, 200, 90, 50, 60, 150, 250, 300, 60, 50, 40, 100, 200, the same. 126.25, where it is? This is also wrong. Oh, completely taking actual prices is wrong. Completely taking averages is also wrong. Then what is right? Considering movement every day is wrong. Considering average is also wrong. Consider averages with movement, which became moving average. Everyone reply. Did you all understood the concept clearly or not? Everyone. Considering movement every day is wrong. Considering average is also wrong. Therefore, consider what? Averages with the movement. That's how it became the concept of moving averages. Understood the point clearly? Yeah. So now what happens? Okay. Now, see here. Therefore, experts found that considering completely averages are wrong. Completely considering simple average is also wrong. Then what is right? Consider moving average. Okay. How to compute now? See here. See here. What is all this concept? Why we are doing all this? Hey, don't tell exams or marks. That is okay. Concept. Why we are doing this concept of moving average? In order to guess or forecast how the prices of shares will be. Forecasting purposes means we wanted to forecast how the share will behave. So for that forecasting, these concepts are important. Okay. Same data I considered. What data? Yeah? Same data I considered again. Now we are not doing average. We are doing moving average. Means we are not considering static. We are considering movement. But we will not consider daily movement. We will consider every 5 days movement. Hey, listen. Yesterday, rise. Today, fall. Yesterday, rise. Today, fall. Next day, rise. Next day, fall. We don't consider. Completely do not consider any movement just to do static. That is wrong. So considering everyday movement is wrong. Considering the simple average is also wrong. What is right? Take a set of data. For that set of data, you calculate average and continue. So how that will happen? Like this it will happen. Everybody in the class take calculator. Take calculator. Okay. Day 1, 100. Take on that calculator. Plus day 2, 110. Plus day 3, 120. Plus day 4, 150. Plus day 5, 200. Stop there. Total them. How many days? 5 days. Divided by 5. How much? 136. That is the 5-day ki moving average. Okay, 5-day ki moving average. What I said? Averages are calculated for expectation. Averages are calculated for what? Expectation. So therefore, this average price is expected to come for the next day, for the 6th day. But 6th day, we expected 136. Actual came to 90. Actual came to 90. So moving average also will be changing now. So Don't consider day 1. Now day 2 onwards 5 days you need to consider. Day 2, 110 plus 120 plus 150 plus 200 plus 90 divided by 5, 134. This is expected for the next day. We expected 134, it came to 50. It came to 50. Again recompute. Okay, 120 plus 150 plus 200 plus 90 plus 50 divided by 5, 122. This we will expect for the next day. We expected 122, it actually happens to be 60 only. Understood the point clearly? Yeah. So like this we will calculate for every 5 day average. Taking full data average, only one answer will come, simple average. Taking everyday price movements will be reflected. So every 5-day behavior we will consider. Don't judge the character of the person by his immediate event. Don't judge the character throughout also. Take decent amount. Last 6 months how he behaved. On that basis, you judge the behavior of that person. Everyone understood the point clearly or not? Everyone understood 5-day moving average? Very nice. Okay. Okay, well, now see here. Now see here. I will ask you one question now. I will ask you one question now. Please. Concentration required. Okay, concentration required. Normal chart look like this. Average chart look like this. Actual analysis is right, average analysis is right, both are wrong. Both are wrong. Do you know what is the beauty of this moving average? See here. 100, 110. Actual prices. 100. See my body language. 100, 110, 120, 150, 200, 90, 50, 60, 150, 250, 300, 60. Now steep rise is there, steep fall is also there. People will get scared if they see stocks like that. But that is not the real behavior of that person. That is not the real behavior of that stock. You take 5-day averages, it is more smoothened. Okay. Do you know what is the beauty here? See the pink color content. 136 became 134. 134 became 122. 122 became 110. 110 became again 110. Again it became 120. It became 160, 164, 162, 140, 110. See the fall between high and low. Here if you observe, 300 is the highest, 40 is the lowest. Difference is 260. Here highest is, lowest is 90. Highest is, how much it is? 164. 164. Hardly it is not even 100 here. So when you see actual data, the difference is 260. And when investor, how he will feel? If I put my money today, I may lose maximum 260 rupees also I will lose. And they don't invest in that stock. So, but really that is not the behavior. Really that is not my character. Why you are judging my character on the basis of immediate before event? Take my character for the last 6 months. Like that this stock also is saying. Why you are judging me like that? Judge me in a proper way, then you will understand my real character. So 136. Okay, see. I will write the point. 136 became 134, became 122, became 110, 110, 120, 162, 164. Okay, became straight line. Okay, so when you observe this curve, how it is, zigzag. When you observe this curve, 136 will become, sorry, 136 will become 130, 136 will become 134, 122, 110, 110, 120, 162, 164, 162, 140, 110, 90. How this is, do you understand? How smooth the character is now? When you say to someone also, okay, that is a normal, na? Every human being will have ups and downs in his behavior. This is okay. Okay, and every 5 day, if you observe my character, what will happen? You will really understand how my mental status is. Same thing also with the shares. Don't analyze the behavior of a stock on the basis of immediate before event, not even on full average. Full average will show that always to 126.875. Every day, actually, if you take zigzag patterns, will come. So that is wrong. This is also wrong. Therefore, this is how the smoothing effect will be. That 136, all these are there. Na? If you plot them, it look this way. Okay. This is actual price. This is average. Okay. This is moving average. See how nice smoothing effect. Okay. So if you remove these, like totally, how it look like this it will look. Okay. Or exactly this one, na? Like this it will look. So how smoothing it is? No great ups and downs. Ups and downs are there, but not that much heavy. Okay. First of all, everyone give a reply. Understood or not? Okay, wow. Now, if you understand also this, then we will go into the main concept, which is exponential moving average. During this exponential moving average, I will show you the formula analysis problem. Then we will go to ICA question directly. Okay. Then we will go to what? ICA question directly. And we will try to solve this. Once this is solved, then we will go into efficient market hypothesis. Read this. Okay, everyone. Everyone, did you understand? If you are okay up to here, we will go into the final main question. Okay, we will understand that and we will start doing the problems. Okay, now see here. Main hero of this topic discussion is to understand the concept of exponential moving average. What is this? Exponential moving average. Our target is to learn this now. What is exponential moving average? See, actual prices is wrong. Average is also wrong. Static average. 5-day moving average, again people started throwing stones against it. What they started throwing stones, what they started doing is, okay, you are taking 5-day moving average. What is the purpose of taking 5-day moving average when your mistakes are not properly rectified? You did not understand my question. Nah? Listen again. They said this way. You are taking 100, 110, 120, 150 plus 200 divided by 5. You got 136. You are expecting 136 to happen the next day, forecast. But actual happened to be 90. Means your forecast did not happen. That's how stock markets will behave. If whatever I expected happens, now why it is called a stock market? Correct or not? So therefore, you expected 136, but the actual happened is only 90. Correct? And then there is a mistake in our forecast or not. Where you are putting that mistake number, in what way you are going to rectify that mistake? You are continuing the same mistake for the next 5 days. Therefore, there is one element which was brought into picture through exponential moving average called as alpha. Number one, what is it? Alpha. And number two, error. What is it? Error. Error term. What is this error term? What is this alpha? That is the first important question everyone has to understand. So exponential moving averages question, two things plays a crucial role. Number one, alpha. Number two, error. What is error? Error is a difference between my forecast and actual. Okay, understood. What is alpha? Alpha is the smoothing exponent. What is it? Smoothing exponent. Sir, what is the smoothing exponent, sir? I will tell you. Listen first. Listen. See, exponential moving average. Same data. Everything is same. 100, 110, 120, 150, everything taken as it is. Okay. Forget about these two. Don't see now. You won't understand. Okay. That's why calculations done in the next page. For 4 days, same will apply for the entire data. Okay. Listen. Exponential moving average value of day 1 will be the forecast value of day 2. What is exponential moving average? It's an average. Forget about exponential moving. It's an average. What is average? Average is always used to expect. So day 1 exponential moving average will be the day 2's forecast price. Okay. This can be calculated as under. If formula, if you forget, that's it. Your 8 marks are gone. Observe the formula properly. I will explain the logic of the formula. I promise you at the beginning of the classes itself. We are not going to do PDF reading. We are going to understand how and when to put the formula and logic behind the formula as well. Correct? Let's start. First, F means forecast. FT, forecast for current period. So F we understood, T we understood, FT also we understood. FT, FT, over. Next, FT minus 1, forecast for the past period. That can be one day before or 2 days before, anything. Next, actual for the past period, forecast for the past period. This gives you the error. Okay, error in the last forecast. Next, alpha, smoothing exponent. Alpha is the smoothing exponent. Smoothing exponent, there is a formula also. 2 divided by n plus 1. N means number of days you are considering. N plus 1. 2 divided by n plus 1. Okay, 2 divided by n plus 1. This is how they will consider the data. First of all, everyone in the class, You kept the heading exponential moving average. Nothing, no theory to be written. Nothing. Don't waste time that way. Write down the formula and write down these notations properly. Once you complete, let me know in the line. I will go into the next concept and we'll start doing the problems. During the problem discussion, I will tell you the logic of the question. Okay. Yeah. Now let us start doing the question. Okay, let us start solving the question. See here. First, F forecast T for the current period. FT minus 1 forecast for the last period. AT minus 1 actual for the last period. FT minus 1 forecast for the last period. AT minus 1 minus FT minus 1 error in our forecast into smoothing exponent. Okay, smoothing exponent means 2 divided by n plus 1. Okay, one by one, let us first try to understand. Okay, wow. So now first question. Forget about the smoothing exponent now. Already I have given alpha as 0.2. Alpha as what here? 0.2 I have given already. So consider that directly. Okay, consider that directly. So what is that alpha? All these things we can discuss later. So consider that 0.2. This was directly given in the question. Okay, smoothing exponent 2 by n plus 1, all those things you need not do. Directly consider 0.2 as a alpha. They have given in the question. First thing, let us take our data. What is our formula? What is our formula? Exponential moving average ft equal to ft minus 1. This is the first element plus a t minus 1 minus f t minus 1 into alpha, not plus, into alpha. Okay, first let us consider for ft minus 1 we need to consider na. So first day 2 forecast I want. Forecast for day 2 will be dependent on forecast for day 1. Day 1 key forecast average exponent everything will be 100. Nothing is given. 100 plus actual t minus 1. Actual t minus 1. How much? 100. Let us say the forecast of 0 day is 100. So actual also need to be 100 minus. What is the forecast? 100 into alpha 0.2. So 100 plus 0 into 0.2 0. So F2 equal to 100. That's how the forecast for day 2 became 100 here. Okay. Forecast for day 2 became 100 here. 1 point completed. Day 2 ki forecast. But actual became how much? 102. Now we need to consider F3. F3 means F2 plus A2 minus F2 into point. How I got A2? T means 3. 3 minus 1, 2. 3 minus 1, 2. Like that we have done. Forecast for day 2. 100 plus actual for day 2. Actual for day 2. 110. Forecast for day 2. Like this we need to consider. 110 minus 100. Forecast for day 2 is how much? 100 into 0.2. So 100 plus 10 into 0.2, 2. So 102 is the forecast. This is the forecast for the day 3. Forecast for the day 3. Like this we will do. Okay. So 102 we got. Forecast for, we got an average for the day 2 as 102. That will become the forecast for day 3. So for a day 2 we have done average. We got a forecast. That forecast will be for the day 3. Okay. So now I will put this like this. You try to work out on your own. First write down the formula. Ft equal to f t minus 1 plus a t minus 1 minus ft minus 1 into alpha. Okay. You do it for f5. Not even for f5 yet. Do it for forecast for 4th day you do. This is the data. Try it. If you do not do along with me, yeah, live you will not do, exam he will give. I'm telling you, complete in live itself. That's it. Once YouTube video is removed, at that time I will get hundreds of messages. Please upload like that. Try on your own. F4 you need to try. See, F4 means forecast for day 4. That depends on forecast for day 3 plus actual for day 3 minus forecast for day 3 into alpha. What is the forecast for day 3? 102 plus actual for day 3 120 minus forecast for day 3 102 into 0.2. 102 plus 18 into 0.2, 3.6. 105.6 is the forecast for day 4. Actual will happen 150. Okay, so actual will happen as 150, and the next again the exponential moving averages will be recomputed and calculated. First of all, everyone give me one answer. Did you understand how to do? F5, okay, I didn't ask. Mainly F4 is the main thing. Did you understand, everyone, how to do? I want one reply from everyone before we start with the ICA question. Did you understand how to solve? If we go through the exam question, will you do? Everyone, can we start doing the exam question in this regard? Okay, now like this we need to compute. Okay, next ICA question. ICA question. This is beautiful question here, tested for 8 marks for around 7-8 times in exam. Same question is coming even in my question bank. If you see, same, see here, same thing. November 2009, RTP 17, MTP 17, MTP 18, MTP 18, practice manual, study material, everywhere same question. See, same again, same 14,522. So it's a study material question. So and again asked for 8 marks in the exam. Okay, sir, what is this question, sir? This question is on next concept. Okay, this question is on next concept. So this is called as a run test. I told the 3 learning objectives. First learning objective, exponential moving average, we are doing now. Next one, efficient market hypothesis and run test. A run test, efficient market hypothesis, both together question will be tested. Okay, that will be question 3. With that, we are going to complete the logics of this particular chapter. Okay, well, sorry. Anyway, our work is now to solve this question. Okay, I will give you 2 minutes time first. Read the question, understand the data they have given. Okay, read it. Have you read the question or not, everyone? I gave enough time for you to read the question also, everyone. Can we move on to the problem? Okay, now see here. What he is asking, closing values of Nifty from day 6 to day 17th of a month. In the month of January given. Day 1, 2, 3, 4 like that they have given. Trading days are also given. Day 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Calculate exponential moving average of Sensex during the above period. Previous day exponential moving average of Sensex can be assumed as 15,000. The value of exponent for 31 days is 0.062. Exponent means what? Alpha. Smoothing exponent. Okay. What is the formula? 2 divided by n plus 1. Correct? 2 divided by n plus 1. Here n is 31. Take calculator. 2 divided by 31 plus 1 means 32. Take 0.0625 at 0.062. That's how they got the answer. Now did you understand how to calculate alpha if nothing is given? Everybody reply. Okay. Now doubts will come. Okay. Now doubts will what? Come. See here. What is the doubt that student will get? Sir, are you okay, sir? But why alpha formula is 2 divided by n plus 1? Okay. Why it will be like that? Okay. So 2, why 2, sir? Why 2? A 3, why it should not be? Why it should not be 5? And why it should be n plus 1? Why it is not n? Like this, doubts will come or not? I will tell you the reason also for that. Listen carefully. Why they have taken 2 now? Whenever you wanted to compute average, you need to consider this day with another day. Simply day 3 depends on day 4 or day 4 depends on day 3. And how many days data you are going to analyze? Every 2 days data only we are going to analyze. Correct? That is reason number 1. And you are taking data. Behavior, whenever you take the behavior of particular data set. Here they are asking for somewhere around 7 to 8 working trading days. Okay. Smoothing exponent should be taken on the basis of a bulk amount of days. Therefore, they have taken for 31 days. How many days here? 31 days the behavioral pattern we will understand and we will smoothen that. Okay. Normally, what is the formula? Listen to my words. Okay. Ft equal to Ft minus 1 plus At minus 1 minus Ft minus 1. That's it. Answer over. Means what? Indirectly into 1 you are multiplying. Indirectly into 1 you are multiplying. If nothing you take, see. Ft equal to Ft minus 1. Okay. Plus At minus 1 minus Ft minus 1. If you stop with this, what is the meaning? Alpha is there still, but alpha is 1. Okay. And every one day behavior again you are analyzing. Don't analyze behavior on the basis of 1 day. You will get wrong answer. Means you are considering my character from 1 day before. Take my smoothened character over a period of time. Not period of data. Period of time you take. Here 31 day period I am going to analyze. So 31 day key, why we are taking 32 days? As the next question. Okay. Tell me. Tell me now. I will start analyzing on 12th of March. I will close on 16th of March. Okay. I will close the analysis on 16th of March. Now, how many days we are considering? 16 minus 12. How many days here? 4 days. How many days here? 4 days. Wrong. Whenever you are considering days, your general mathematical rule of 16 minus 12 do not apply because you should count like this. 12, 13, 14, 15, 16. Mathematically, 16 and 12 means 16 minus 12, 4a. But when you compute on a day basis, you should consider also 12, 12, 13, 14, 15, 16. And a normal mathematically, how many we need to add? 1. That's why denominator like n plus 1 came. That's a logic. Understood or not? Repetition not possible. I'm very, very sorry. We have to complete the chapter. I'm very sorry. Listen to the first time. I'm explaining slowly only here. I'm not even going faster. Okay, so other meaning, why they have taken 2 divided by n plus 1, why they have taken, don't consider my character on 1 day basis or 5 day basis, 6 day basis. Take a good amount of time to analyze me, smoothen my character, then you decide I am good or bad. Okay, the logic. So now we know alpha, we know numbers. Our work is to compute. Okay, see here, one computation let us do. What is that? First, we will compute for the day 6. Okay, day 6 key, let us calculate a forecast. Okay, day 6 we will calculate exponential moving average, that will become the forecast for the day 7. So day 7 equal to day 6 plus day 6 minus, sorry, very sorry, f7 equal to f6 plus a6 minus f6 into alpha. Okay, what is the forecast for the day 6? What is the forecast for the day 6 here? That's why the previous day is assumed to be 15,000. Previous day assumed to be 15,000. And the previous day assumed to be 15,000. Okay, I don't want to waste our time also. I will show and I will explain directly. That's easy for me. Speed we can complete the chapter. 6/1/2020. Actual 14,522. Okay. Calculation. See the formula. Ft equal to Ft minus 1 plus At minus 1 minus Ft minus 1 into alpha. Formula already I have written. See, F7 I want. Okay, F7. Okay. Sixth key, we don't compute forecast for sixth. Sixth key already actually there. Why to forecast? Forecast is for the seventh one. So exponential moving average is calculated and that average will be the forecast for the next day. So F7 equal to F6, 15,000. Who gave? They only gave. F6 key, they have given or not? 15,000. That's a 15,000 one. Okay. So what is this? Previous day exponential moving average is 15,000. Okay, exponential moving average is 15,000. So forecast for 6th 15,000, but day 6 we expected 15,000, but actually only 14,522 happened. Big error is there. So plus 14,522 minus 15,000 into 0.062. Okay, you can take calculator. 14,522 minus 15,000 into 0.062 plus 15,000. 14,970.36. What is this? Exponential moving average. Why this will be used? This will be used as the forecast for the day 7. Forecast for day 7. That's why day 7 okay, forecast will be the previous day's exponential moving average. How I got this? This they have given in the question itself. That's why star mark I have given. 15,000 is the value of EMA on day 5. That means on day 5, 15,000 is taken as day 6 forecast. Okay, wow. So next, day 7 key forecast is 14,970. Actual became only 14,925. On day 7, we will be estimating the day 8th forecast. How to calculate? But here, day 7 after, day 8, 9 trading. So don't consider. Directly go to F10. Directly go to what? F10. F10 equal to F9. F9 not there. F8 not there. 9 will become 7. Okay. Okay. Day 10 equal to formula. We will write F10 equal to F9 plus A9 minus F9 into alpha. So F10 equal to F9. 14,970. Our forecast. Plus A9 actual. A9 means the 7th you will take 14,925. Okay, minus forecast 14,970 into this. You will get a forecast 14,967.55. That will become the forecast for the day 10. This is how computations will continue. Okay, well, so I am putting it before you. Take calculators, everyone, observe the numbers and solve and confirm me whether you understood or not. Understood everyone? Okay. Sir, every adjustment, everyone understood clearly? Yeah. Full adjustment, full problem, all numbers. Did you try and tally it? Our decimals is always a 2-digit decimal. Okay. So now you tried this question and you completed. Same thing will come in exam. Numbers will change. Okay. Trading day, holiday dates will change. That's all. Concept is same and alike. Okay. So first of all, we completed exponential moving average. Next one is efficient market hypothesis and run test. Correlation test question also will be there. Portfolio chapter we will do that because correlation anyway we have to do there. Okay. Mainly this one we will do now. Keep the heading efficient market hypothesis. Keep the heading efficient market hypothesis. So question bank we have done this question. Similar model question is this one. This is also done. Now we are going to do this question. Same did question we are going to do. Same with auto correlation test and run test question. That's what I told you. Remaining is theory. Remaining is only theory. Okay. Same. See, exam another 4 times this question came. Same numbers will change. Again question came in exam. Same numbers will change. That's it. Chapter over. There are 3 models. 2 models exactly. Third model is there na. This one. Correlation, serial correlation. This we will do in portfolio chapter. Okay. Portfolio chapter we are going to do this because there anyway we have to compute correlation. So at that time we will do this. Okay. Even if I forget, you please remind me, sir, in security analysis, we are having auto correlation test question pending. Then I will come back and I will explain you. Okay, wow, everyone. Okay. Now, in security analysis chapter, we are going to start with the final concept, which is called as efficient market hypothesis. Okay, efficient market hypothesis. What is this concept? Exponential moving averages concept will be useful for us to understand the price movements of a share. Correct? Price movements of a share and a behavior of a share you can call price movements you can understand, and how volatile a particular share can be understood through efficient market, will be understood through exponential moving average. However, efficient market hypothesis will be useful for analysis of the market to make gains out of it. Okay, to make gains out of it. Analysis on the market and making gain out of it. Sir, I didn't understand. How will you understand? It's a very big concept. Okay, I will first explain you from the bare basics, then we will go into the main analysis. Okay, let's start. Let us consider a company X Limited and observe the share price movements in the last days. Okay, last days. X Limited. There is a company called as X Limited. This X Limited company, these are the share prices. Day 1, day 2, day 3, day 4, day 5, like that 10 days, 10 trading days. Prices also given. 100, 105, 110, 115, 120, 125, 130, 135, 140, 145. Okay. How the chart will be? Days will pass by. Okay, days will pass by 100, 105, 110, 150, 120, 125, 130, 135, 140, 145. Okay, so what happened? Straight line is formed like this. Correct? So the behavior of this particular share is very easy to understand because nothing great happened. All the time the share prices are moving only on the upward direction. Next, there is another company. This company has a price rise and fall. What is the price rise? 100 will become 120, 120 will become 120. Sorry, 100 will become 110, 110, 120, 120, 130. Like this, it will grow. After 140, 135, 115, 110, 131, 142. Like that, it will grow. So pattern is like this. Okay, rise and fall pattern I have drawn in the chart. Green, red, green, red, like that. Green is rise, red is fall. This is how the share pattern of this particular share Y Limited company. Next, Z Limited. These are the prices. Zigzag manner share prices are given. Correct or not? Okay. Now listen carefully to the concept. Okay. Listen carefully to the concept. Like how you listen to the previous one and became expert in understanding the question and answer. Same thing you are also going to do here. Listen. What will happen in this concept? See, there are two types of analysis. Number one, fundamental analysis. Number two, technical analysis. What is a technical analysis? What is fundamental analysis? Technical analysis means I will do the charting analysis, candlesticks analysis. I will see the chart pattern of a company. If I see chart pattern of a company, it is showing a pattern. On that pattern, if I go, I will make profit. That's all. That's called as fundamental analysis and making of profits. Sorry, I'm very sorry. Technical analysis and making of profits. What is a fundamental analysis? I don't know the charts, the stock market language, television, they will display the share prices, candlesticks, bands, resistance level, support level. I have no clarity on anything. But I have ability to read company financial statements, understand the performance of that company. I will do ratios analysis. I will do full length company diagnosis, and then I can tell whether this is a good company or a bad company to invest. That knowledge I have. Now I am having fundamental analysis. Now I am having what analysis here? Fundamental analysis. So what is the logic now? Tell me, what are the 2 points that we understood? There are two types of analysis: fundamental analysis, technical analysis. Technical analysis, we are going to analyze the stock prices, charts, chart techniques, candlestick patterns, all these external factors of the stock market we will analyze, and we have ability to make profit out of it. That's called as a technical analysis. I don't know all those, but I can read company balance sheet to P&L, understand the ratios, and tell whether the company is good or bad. This is fundamental analysis. Why we are discussing? Listen, on that only this chapter started. There is a person. Let us say Kaushal Mukesh is there. I have a fantastic knowledge on technical analysis. Really, also, I hope that I am having a very good knowledge on technical analysis because I do a lot of stock market sessions now. And now I will give time for you. I will give time for you. Analyze chart 1, chart 2, and chart 3. 1 minute each. More than that, also, I will not give time. Okay, Have you done the basic understanding? Have you at least observed the price movements, everyone? Participate, yeah, everyone. Have you observed the price movements? Okay. Now listen, I will tell. Okay. Sir, why I gave time na? At least you should put your mind. Then you will understand. What I am going to tell, you should at least have some expectation. Na? So before that, see this third chart. Okay, 1 minute time. Okay, let us continue. See here. There is a zigzag price movements. There is a price movement. There is a price movement, but standard. Okay, see here. It is very easy to analyze A limited share, the X limited share. Do you know why? Whenever you invest, definitely you can sell at a higher price. Means when you see the chart, it is very clear. You buy at a lower price, sell at a higher price. Buy at a lower price, sell at a higher price. Buy at a lower price, sell at a higher price. Bonanza profits you will make, and a person who can read the chart can clearly tell that invest at low price, definitely it will rise and you will make a gain. This is called as person making a gain out of technical analysis. Not understood? Huh? I will show you analysis notes. Read this. Okay. So what you have to understand, see this. One thing everyone can tell. A small kid also can understand one point. If you invest at a lower price, you can get at a higher price. See the chart. Okay. So now let us go faster. I think you are now understood the pace of this particular concept. Okay. Let us have a clarity. See, price of the shares is very clear. And when you need not even see 100, 105, 110, 115, all those things. Okay. Just one thing you can tell. You invest in this share, it will never fall. It will go on rising. Means what? You buy today. Okay. You buy today and sell later. Okay. You buy today and sell later. Whenever you buy and sell, you will make a gain. Now you read these notes. Okay. First of all, everyone confirm me one thing. Did you understand the basic discussion what we are making now? Did you understand the basic discussion what we are making now? Patterns we are going to understand. Now listen fast. We have no time. We have to complete. So what we have to understand from the first chart, it is compulsory that you invest somewhere. Definitely will make a gain. Definitely will make a gain. Sir, I will invest on day 10. Yes, day 11 it will increase, will make gain. Day 10 I will invest, sir. Day 11 it will make gain. Day 25 will make, sir. Day 26 you will get a gain. And there is a conformity that if a person can see the chart and understand technical analysis of that stock, everyone can make profit. And what is happening here? You have knowledge on technical analysis. I have no knowledge on technical analysis. Okay, and a person's having technical analysis knowledge will make profit means then why investors has to stay in the market? Such a kind of situation is inefficient market. Such kind of situation is a inefficient market, not efficient, inefficient. Why? Market la everyone should be equally placed. Knowledge person can analyze market, but he should not be able to predict the market. Clear or not? For example, I have knowledge on candlesticks. All these things means what? I can understand patterns of the shares. I can understand the psychology to some extent. But no one can give a guarantee that surely you will make a gain. Correct? So second, now is predictability possible in the second case? Definitely yes. Do you know why? See, whenever there is a rise, that rise is not permanent. There will be a fall. Whenever there is a fall, that fall is not permanent. There is a sudden rise. And what people will do now to make a bonanza profit, they will buy during the red line and they will sell during the green line. And there is a market tendency. Now again, people having technical knowledge will understand out of the past trend. Hey, this share is falling now. Buy now. If you buy now, you can sell later and make a bonanza profit. Like this, people will understand. That's why this is also a predictable trend only. Third trend, same thing they will do. Right, this share will have more zigzag patterns, but whenever there is a fall, there is a rise. Whenever there is a rise, there is a fall. Buy during the fall, sell during the rise. Understandable patterns. Y limited graph throughout, though not like X limited, it still communicates a pattern where when there is a rise, that rise trend continues for a length of time. And when it is a fall, that fall also have some length of time to continue. Buy at fall and sure gain at rise. Z limited. Even Z limited, though a zigzag pattern, still communicates a predictable trend. Whenever there is a rise, it follows a fall and vice versa. Buy at fall and sell at rise. Okay, means what? You observe one point here. Whenever there is a fall, there is a rise. Whenever there is a fall, there is a rise. Means there is no continuous fall. Zigzag manner rise is not there. Whenever there is a bigger fall, there is a rise, whether small or big. Okay. Here, whenever there is a small fall, there is a bigger rise. Here, whenever there is a bigger fall, there is a small rise or big rise, but rise is happening. So these are all the trends that you can understand from the charts. Okay. Means a person having a evaluative knowledge on the charts, having a technical knowledge, what he will do? Surely he will make a gain out of stock market. This is how stock market should not be. Then only those people will make gain. So therefore, what they have done, see, from all the three above, three examples predicted as follows. X limited, buy, sell, buy, sell. Means when there is a fall, you buy. When there is a rise, you sell. Y limited, sell during this, buy during fall. Sell during this, buy during fall. Like that. So here, more zigzag patterns are there. Na? Buy, sell, buy, sell, buy, sell, buy, sell. Like that you have to do and make a gain. In all the three cases, there is a sure way to make profit. Means an analytical time to buy and sell the stocks. That means a market where profits are dependent on technical analysis of the stocks or technical analysis of the charts and graphs will give rise to profit. It is called as inefficient market. It's called as a inefficient market. Okay, please read the notes properly. popular theory question, meaning of the term efficient market. Okay, everyone. Okay, wa? So from this, what you have to understand, whenever there is a rise, there is a fall. Whenever there is a fall, there is a rise. Patterns are understandable patterns. Patterns are what? Understandable patterns. Okay. Listen carefully. See the screen. Popular theory question I'm covering here itself. There is one financial analyst called as a farmer. Okay. He said there are two types of markets. You can see on the screen. One is efficient market. Another one is inefficient market. What is an efficient market? Efficient markets you keep away. First read the inefficient market. What is inefficient market? It is a market where profits are made simply by technical analysis of the stock. Okay. If the technical analysis fails, market becomes efficient. Means what? Persons who is having a stock market knowledge will make gain. Means everyone will get the knowledge and they will make a gain. So that's how not the market should be. So if the profits are made simply by making technical analysis of the stocks, then we call it as inefficient market. Sir, I have a very good technical knowledge. I made very good technical analysis. Still, I could not make a gain. Then markets are efficient. Markets are efficient. Efficient markets are again categorized into three: weak form, semi-strong form, strong form of efficiency. What is weak form of efficiency? It's efficient only, but not that much strong. Means what? Technical analysis fails. Technical analysis fails. Therefore, inefficient became efficient. However, profits can be made by making fundamental analysis. So there, technical analysis person may not win, but having a good command over ratios and everything in financial management, people can make a gain. That's called as efficient, but weak form of efficiency. Second one, semi-strong form. What is the semi-strong form? Technical analysis fail, fundamental analysis also fail. So then how can I make a gain? Only by insider trading. Whether that is allowed, fraudulent, that is all different. The only way of making a sure gain is insider trading. Like that only you can make a bonanza profit. Then we call it as a semi-strong form of market. Okay. Last one, strong efficiency. Technical analysis fail, fundamental analysis fail, insider trading fail. Only option is buy the share, hold, wait till it rise, and then sell and make a profit. Like us, normally. So therefore, markets today are strong efficient market. Strong form of efficiency in the market. So Kaushal Mukesh have technical knowledge. I have fundamental analysis, and I don't even have insider trading. But still, I am losing money sometimes. Means what? Markets are efficient. Markets run because of demand supply, not because of your technical and fundamental knowledge. Such markets are called as efficient markets. Everybody in the class, please reply. Understood the logic clearly or not? Everyone, don't sit idle. Reply. You understood and observed the concepts properly. Yeah. Now, listen carefully. We are done almost 60%. 30% problem, 10% subject discussion is there. Chapter will be over. So please concentrate properly. Now I'm going back. Final touch. Problem we will solve. Final touch. What is the final touch? Listen. Now what they will do is, whenever the price movements of a share are very low, predictability become easier. Predictability will become easier. Whenever the price movements are very high, and at that time, predictability becomes easier. Sir, I didn't understand. I will repeat the statement. Listen. They say, pharma says that whenever the price movements, okay, price is at 100, became 101, okay, became 105, like the movements. When price movements are very, very less, okay, very less price movements are there, predictability is very easy. Means what? I know that price will not move. Then I will predict accordingly. Price will move only once in every 4-5 days, or else it won't move. Then I can understand clearly. Buy and wait for 5 days and sell. Predictability is very easy. The price of the share will move like a monkey up and down. One place it will not stand. That also very much predictable, because higher price movements will give an impression that whenever there is a fall, there is a rise. So therefore, high price movement stocks, inefficient stocks. Do you know why? Predictability through technical analysis is easier. So low price movements are there. Predictability of the stock becomes easier. A low movements key, X limited, Y limited will fall. High price movements key, Z limited example will fall. Everybody, did you understand the point clearly or not? Okay, what? Yeah. So whenever the price movements are very sharp, predictability becomes easier. Whenever the price movements are blunt and are not changing, predictability is easy. Therefore, when you call a particular stock as efficient stock, the price movements should be such a number. See, how many price changes? Only 2, predictable. 100, predictable. The number should not be in the very less extreme. Number should not be in very high extreme. Predictability is very easy when price changes 100 times in a 1 minute time. Means if you buy now, next minute price will not be there. It's a prediction.